This is the third video that is going to illustrate the format of the income statement. In the first two, we talked about in one the revenue section of an income statement, and in number two the expense section of the income statement. And in both cases, the entries that go into the different rows simply come somewhere from a chart of accounts. So now you begin to realize that the chart of accounts is critical in developing the two major financial statements, the balance sheet and the income statement. In this video, we're going to talk about the last segment of the income statement, which essentially is where you calculate profit. So we're going to be talking about this little section right down here at the bottom where we actually compute profit. Now be careful here because the words mean something very specific. In the income statement, when you get total revenue, and then right here you get total expenses, when you take total revenue and subtract total expenses, you get something called net farm income from operations. Net farm income from operations. Now, folks, that's a very important word. All of the analysis that we will do on the financial statements actually uses net farm income from operations because, and here's a good essay question for a quiz, this is the net profit on the farm from the typical normal operation of the farm. Now, let's say that again. This is the profit on the farm from the typical operation of that farm. So in other words, this is a profit that you made on the farm from producing and selling the things that you're actually in business to produce and sell. Okay, well, now how can that be different from something else? Well, sometimes you sell old pieces of machinery, you sell a little land. In other words, sometimes on a farm you sell and get cash money for some of the items that are in that non-current asset section of a balance sheet. Those are not typically sold on a year-in, year-out basis. It's just something that you might simply need a new tractor, and instead of trading the old one in, you sold it to a neighbor. Because those are non-typical transactions, they are not included in net farm income from operations. They are listed on a row here called the gain or loss on the sale of capital. Now, I'm not going to explain that right now because I'm going to devote a section to it a little later on. But just to briefly tell you what that means is, let's say you sold an old tractor off of your farm so you could go buy a new one. Perhaps that tractor was on your books. In other words, it had an undepreciated balance of $5,000 and you sold it for $7,000. Well, what would go here would be the $2,000 difference. But again, we're going to explain that more later. So now when you take net farm income from operations and you add the gain or loss on the sale of capital, now this could be a positive or a negative number, then you get something called net farm income. Now, what is so common among students of farm accounting is they think this is the ultimate number you're looking for, net farm income, and it's not. It is not the number we will really use to evaluate a farm. What we will really use is net farm income from operations because that's the profit from the typical operation of a farm. Think of it like this. What if you had net farm income from operations for 4 or 5 years, and just suppose those numbers were somewhere in the neighborhood of $85,000. Maybe 81 year, 85, maybe 92, maybe 78, but they were pretty consistent. And all of a sudden one year you come down here and for some reason you sold $300,000 worth of land. And that $300,000 worth of land, that was the gain on that. Well, if you added that to your income in that year, then down here in net farm income, you would obviously have something like $380,000 net farm income. So how would you compare that year to the other years where your income was sitting there around 80 or 85,000? It wouldn't make any sense because it would look like you were such a better manager in that one year when in reality you sold something very unusual. So very quickly in summary, remember, net farm income from operations is simply revenue minus expenses, and this is the number that we're most interested in evaluating a farm. But If you do have unusual sales of machinery, equipment, land, or something of that nature, to, non-current type assets, then you can add that or subtract it if it's lost from net farm income from operations, and you get something called net farm income.